Good morning and welcome back to Before the Bell with Roman and Zain. Today's Thursday, August 28th, 2025. As we head into the final trading day of the week, the market isn't just navigating a new earnings cycle, it's grappling with a three-front battle. We have an AI revolutions report card, a geopolitical chess match between two global powers, and an unprecedented legal fight for the soul of the Federal Reserve. Zane, it's a lot to unpack.
It certainly is, Roman. It certainly is. Normally, a single one of these stories would dominate the headlines, but the past 24 hours have shown us just how interconnected and fragile the global financial system really is. The market's initial reaction to NVIDIA's earnings wasn't what anyone expected, and it's a perfect encapsulation of the contradictory signals investors are trying to make sense of.
Exactly, Zane. Today, we're going to be connecting the dots between the stunning after hours move in NVIDIA stock, the quiet but impactful fallout from the US tariffs on India, and the constitutional crisis brewing at the Federal Reserve. These aren't isolated events, they're threads in a larger tapestry of a rapid changing economic and political landscape.
So let's start with a quick market rundown. So we're going to get a quick snapshot of what we landed on Wall Street. Yesterday was a day of mixed signals, with the S&P 500 closing at a new record high, while the tech-heavy Nasdaq finished mostly flat, showing a divergence in confidence across sectors as investors awaited Nvidia's earnings report after the bell. This morning, futures are pointing to a cautious, mixed opening as traders digest the after-hours news. We also saw some volatility in bond markets, with short-dated treasuries extending gains on renewed bets of Federal Reserve rate cuts. Political news out of Washington, specifically the attempt to fire Fed Governor Lisa Cook, was described as adding noise to the market. The latest University of Michigan data shows consumer sentiment fell back about 5% in August, declining for the first time in 4 months, largely due to rising inflation worries, and the bull bear spread is still in deep negative territory, a stark contrast to last year's bullishness. To put some numbers on that, let's look at yesterday's close. Yesterday, the S&P 500 closed at a new record high, up 0.24% on the day. The Nasdaq closed up 0.17%, a 1 week high. This data reveals a paradox. While the broader market indexes were weighed down by general caution, the market is simultaneously maintaining a long-term, high conviction belief in the core growth story. Investors are distinguishing between the macro risks and the micro bullish case for a single dominant company.
I agree, Zane, I agree. Now, time for our bell ringer today, which we're going to talk about the two biggest headlines from the last 24 hours. The first, the most obvious, NVIDIA. The company reported earnings after close last night, and the stock's initial after hours reaction was a drop of nearly 3%. So the question we have to ask our listeners today is, why would the stock of a company that is the leader of the AI revolution in the AI bubble fall after what looked like a solid earnings beat?
That is correct. That is a good question. I believe it was a classic case of the market getting a second thought on a company that is priced for perfection. On the surface, the company's quarter was a slam dunk. Revenue of
Mhm.
46.7 billion. That's a 56% jump year over year. And adjusted earnings per share at $1.05, both of which were ahead of expectations. But the initial after hours drop was purely about the nuance. The market was disappointed by two things: a slight miss on its data center review and a Q3 revenue forecast that simply met consensus rather than blowing it out of the water.
And that's where the story does get interesting, though. We're on air right now at around 2 a.m. before the bell, and traders have had the night to process the full report. So, what are the key details that investors will be looking at once the market opens in the pre market that could shift the narrative from a disappointing day to a buying opportunity?
The narrative shift will be driven by two key factors that reaffirm the long term bullish case. First of all, the company's announcement of a massive $60 billion stock buyback authorization. That's a powerful signal from management that they believe the stock is deeply undervalued. Secondly, CEO Jensen Huang's commentary, he wasn't focused on the next quarter. He was talking about the long term, calling the next several years a quote unquote race towards artificial superintelligence and a $3 to $4 trillion AI infrastructure opportunity. We'll be watching to see if the market chooses to buy the dip, valuing the long term vision and capital return strategy over the near term details.
Yeah, Zane, it's fascinating how a strong long term vision can overcome a near term hiccup. And speaking of long term vision, this isn't just about a single tech company, it's also about the broader economy. And we saw a major show of confidence in the industrial and manufacturing sector as well. Korean Air made headlines earlier this week with a massive deal to purchase 103 next generation Boeing jets with a total investment valued at about $50 billion.
That's exactly right. It's a sign of a massive long term bet on the future of air travel and global trade. The deal, which was formalized on Monday in Washington, includes a mix of different aircraft models and a 20-year engine maintenance service contract with GE Aerospace. It highlights a trend of major airlines moving to modernize their fleets, increase fuel efficiency, and ensure stable capacity growth for decades to come. It's a powerful statement that shows confidence in the fundamental strength of the global economy, even as short term market sentiment remains cautious.
So the bell ringer takeaway from today is that the market is navigating through a complex mix of signals. It's overreacting to minor details in high fly tech while simultaneously making decades long bets on the future of global logistics and manufacturing. The key to this is to look past the day-to-day noise and understand the long-term narratives that are still driving capital allocation decisions.
So let's get into the AI Revolutions report card. And I think a question we should ask is this a perfect beat or a flawed forecast? So, Roman, the initial reaction was all about the nuance. On the surface, NVIDIA's fiscal year 2026 quarter two earnings were a clear win. The company reported a record quarterly revenue of $46.7 billion. That's a massive 56% jump from a year ago, and a beat on the $46.52 billion that the analysts had a consensus on. They also posted adjusted earnings of $1.05 per share, comfortably ahead of the $1.01 to $1.02 forecast. This should have been a slam dunk.
But unfortunately, it wasn't. And that's because the company is no longer just being judged on the headline numbers. The market is, quote unquote, priced for perfection, which means any minor miss or lack of stratospheric guidance can be met with an overreaction from the market. Analysts were fixated on the details, and two things stood out. First, while the data center revenue was a staggering 41.1 billion, it slightly fell short of the 41.3 billion that Walter was expecting. Second, the forward guidance. While Nvidia is projecting a Q3 revenue of $54 billion, which is a massive number in its own right, it's only matched with consensus and fell short of the more bullish expectations. This highlights the near impossible bar set by investors and analysts.
Now let's connect this back to our bell ringer, shall we? The initial after hours drop was an emotional knee jerk reaction. The market was digesting a minor miss on the most watched metric and a guidance number that was simply on the mark, not an explosive beat. The subsequent recovery on Thursday came as investors had time to process the long term bullish signals.
Yeah, the answer lies in two key factors. First, the massive new 60 billion stock buyback authorization announced by the board. This is a powerful signal of management's supreme confidence in the company's future, and it puts a strong floor under the stock, essentially saying, "We believe our stock is undervalued and will buy it back." Second, NVIDIA CEO's commentary. He wasn't just talking about a short term guidance number, he was talking about the long term vision of his company, calling the next several few years a race towards superintelligence and a 3 or 4 trillion AI infrastructure opportunity. The market chose to buy the dip, I believe, valuing the long term vision and capital return over the near term details. This showcases the maturity of AI investment thesis, and it's moving more beyond speculation to a point where capital return and long-term vision are valued over minor quarterly misses.
Now, to provide a clear picture to the listeners, let's look at the numbers and let's make them make sense. The results that have been shown to us directly show how the company is still performing well overall, with revenue and earnings beating expectations. However, the slight miss in data center sales, the core driver of growth, and guidance that only matched forecasts suggested the growth story may be leveling off a bit. In other words, profitability looks strong, but momentum in the most important segment isn't accelerating. The key takeaway here is the divergence between short term metrics and the long term outlook. The initial after hours drop was a reaction to the near term guidance and the slight miss on data center revenue. But a more rational analysis over the next day, we feel will reveal that the long term bullish narrative, supported by the massive stock buyback and CEO commentary, remained intact. The market digested these facts overnight, and Thursday's trading session will reflect a return to the bullish long term thesis. Moving from the corporate to the geopolitical space, as we spoke yesterday, we've now seen the full extent of the new US to India tariffs that have taken effect this week. President Trump's administration imposed a second, additional 25% tariff on Indian imports, bringing the total to a crippling 50% for many sectors. The stated reason for this escalation is India's continued purchase of Russian crude oil.
So this isn't just a negotiating tactic, Zain. It's more of a strategic shock. Many Indian officials estimate that this will directly impact between 48.2 billion and 60.2 billion in exports, potentially making shipments to the US more commercially unviable. We're talking about a massive blow to India's labor-intensive sectors such as gems, shrimp, and leather goods, which are already operating on razor-thin margins. The founder of the Global Trade Research Initiative warned that this threatens to quote unquote wipe out India's long established presence in the US. Some economists are projecting ahead of 0.4% to 1% of India's GDP growth.
And what would be India's response? Their response is a mix of defiance and tactical maneuvering. Prime Minister Modi has vowed not to yield to U.S. pressure to open up its protected sectors, like agriculture, citing the interest of millions of Indian farmers. But on the policy front, the government has taken proactive steps to mitigate the damage. Just yesterday, they extended the duty free import of cotton by 3 months to help textile exporters facing the steep 50% tariffs. This is a classic move to lower input costs and support their domestic industry in the face of external pressure.
Yeah, but here's the broader ripple effect, Zane. The US has actively been trying to shift its supply chains away from China. However, by making Indian goods uncompetitive, this policy could inadvertently push supply chains not to the US, but to other low cost producers like Vietnam and Bangladesh, and potentially back to China for some products. The result could be a strategic goal itself, reinforcing a regional supply chain model rather than a US centric one. However, this is a clear contradiction that shows a lack of a cohesive long term strategy.
Exactly, Roman. But tariffs are not a simple economic tool for balancing a trade deficit. They are also a political weapon aimed at coercing a strategic ally. The explicit link to Russian oil imports transforms the issue from a trade dispute into a foreign policy tool. This geopolitical over economic intent has real world consequences. And let's not forget the impact on the American consumer. While the White House may claim otherwise, analysts from Goldman Sachs and the State Bank of India project that these tariffs will increase inflationary pressures and could reduce the US GDP growth. So, we have a geopolitical move that could harm both American consumers and a key strategic partner, while not even achieving its goal of reshoring supply chains.
I agree, Zain, and I just got breaking news that India's Prime Minister and China's President Xi Jinping are set to meet on August 31st. And I believe that, truly, my opinion, imposing tariffs on India is going to be a US loss. It's going to be hard finding new markets, that is. So now moving on
Definitely,
to, go ahead.
definitely. I believe that it's gonna do more damage than good, and it won't do what the goal was designed to do. What Trump was his goal was, I don't believe it'll hit that.
I believe I believe it's just like how the Biden administration made Russia get closer to China. And it's kind of sad to see that America, it seems like they're self-destructing themselves.
Correct. I
But
believe that 100%.
I agree. But anyways, let's move on to a more domestic problem that is a political challenge to the Fed's fortress. We did touch up on this a little bit yesterday, but we're gonna go more in depth with it this time. So earlier this week, we saw President Trump take an unprecedented and a pretty unconstitutional step, attempting to fire Federal Reserve Governor Lisa Cook. He cited her as a quote unquote criminal referral, alleging mortgage fraud, a claim that Governor Cook has numerously denied and has called Trump as a big bully. And she said she's not going to step down with his bullying tactics.
Now, this conflict is not a normal political skirmish. A Federal Reserve governor is not a cabinet official. They serve a 14-year term and can only be removed for cause, a provision meant to insulate the central bank from political pressure. Cook's attorney, Abby Lowell, was quick to state that the president's action, quote unquote, lacks any factual or legal basis, and that they would be filing a lawsuit to challenge this illegal action.
So, yeah, now this legal battle is a test case for the foundation of the Fed's independence, which is very, very interesting. That is. And it's an open question whether the president's for cause removal authority extends to the Board of Governors in this matter. Experts believe that this fight could ultimately end up at the Supreme Court, creating a constitutional showdown for the years. This is a landmark legal challenge to the long-standing principle of the Federal Reserve's independence, and a ruling that gives the president broad power to remove governors for cause would fundamentally alter the Fed's ability to conduct politically unpopular but necessary policy, such as raising rates. This also represents a systemic risk to the stability of the US financial system.
Roman, I believe it really comes down to like, if you start there, where do you stop?
So yeah, Zain, I agree. Trump has had many interesting quotes about himself being a dictator and that no one could stop him. If the courts don't stop him here, how much further can he go?
Yeah, and a lot of people would wonder what would be the market's reaction to that. And while it wasn't a full blown panic, the sentiment was one of caution. The political noise is chipping away at investor confidence. As Schwab's chief fixed income strategist noted, any attempt by the administration to influence the Fed, quote unquote, erodes confidence in it as an institution. The long term implication is a worrisome one. If the Fed is no longer seen as an independent arbiter of monetary policy, inflation expectations could rise and long term yields could be pushed higher. This is a systemic risk that goes far beyond a single political dispute.
So, to tie it all together, we have the Fed that may be forced to raise interest rates to combat inflation caused by its own government's trade policies, all while its independence is being legally challenged by the very same administration. This is the perfect storm that introduces a new level of uncertainty into the markets that we have not seen in a very long time.
Oh man, Roman, what a week. What a week. We've seen an AI powerhouse navigate sky high expectations. We've seen a global trade partner face a crippling new tariff regime. And the bedrock of US monetary policy face an unprecedented legal and political challenge. It's a testament to the fact that today's financial markets are a complex web of interconnected forces.
Yeah, Zane. And the key takeaway from all of this is that these stories are not silly. The inflation that the Fed is fighting could be fueled by the tariffs enacted by the same administration that's now challenging its independence. The success of a company like NVIDIA, which is supposed to represent the future of growth and the future of AI, is dependent on navigating the same geopolitical trade tensions. The road ahead is a very bumpy and uncertain one, and it's getting more complex than ever before.
Indeed, Roman, indeed. And the markets are always hard to predict, but I feel like recently, especially with everything that's going on, it's just been impossible. You never know what's going to happen next. And as we close out the next week and look ahead, all eyes will be on the legal proceedings for Governor Cook and the Fed. That's the main story right now. The ongoing trade negotiations with India, and as always, the broader macroeconomic data, including the upcoming jobs report. And of course, nothing here is financial advice. We are both students sharing our learning process, learning the game. and stepping our foot in the door. That's all the time we have for Before the Bell. Thanks for joining us.
And we'll see you on Friday.